Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Adrian Day. We're going to be talking a little bit about the pullback in the precious metals, gold and silver prices, as well as driving down into some of the stocks that Adrian is watching and even ask him where he sees some opportunities in those underlying equities. Adrian is the president of Adrian Day Asset Management, also manages the Euro Pacific Gold Fund. Now, Adrian, again, silver, gold after touching all-time highs has pulled back a couple $100. Silver, that broke above 30. Actually looked like it maybe wanted to hold above 30, but recently has dipped below that number and is still at generally a higher price. It's in the $29 region, but again, we've seen a little bit of weakness in June in these metals prices. That weakness even extended to the tail end of May. A lot of different factors to touch on, but Adrian, in terms of precious metals pullback, what's driving it? And do you think this is more of just a natural correction in a much larger, at least 3-month uptrend that we've been seeing?
Yeah, well, first of all, thanks for having me. Well, obviously what caused gold to drop so sharply after 2 up days, it dropped $200 from top to bottom on Friday, were 2 things. First of all, of course, there was the announcement that China hadn't bought any more gold in, I'm talking about the official reserves now, not the Chinese population, of course, that didn't buy any gold in May. So when that news came out on Friday, and then a few hours later, that was followed by what was assumed to be, or what was reported to be, a very strong U.S. jobs number, and that a payrolls report, and that, made people think that the Fed wouldn't be in any hurry to raise rates. And so it was a 1-2 punch. I mean, I think you're right, after you've seen gold go from basically 2,000 up to 25 and then, trading between 23 and 24, I think there were some nervous holders. And no doubt when the Chinese report came out and gold initially dropped, whatever it was, $60, $70, it probably hit some stop losses and some algorithmic selling came in and so on. I think this is only a pause. So there's 2 things, the China and the jobs. I think this is only a pause in China's buying. And if you look at their pattern for the last 3 months, the last 3 months has each been a lower number. So in February, they bought almost 400,000 ounces. In April, they bought 60,000 ounces. So it went down meaningfully. And then it was none in May. So I think in the overall context of what they're doing, we've had these kind of slowdowns in buying before. I think they just want to give the market a bit of a rest, frankly. They've been a driver of the higher prices. So I suspect they'll be back in a month or 2. The big risk that I would see is, and of course, obviously China deciding not to buy gold would be a big risk, but I don't see that. The big risk I would see is if any of the other central banks that have been buyers decide to follow China's lead and pause as well. In May there were a lot of banks buying, so that doesn't seem to be. So far, that's not the case. We'll see. As for the jobs report, I mean, it's really farcical, frankly. The fact that you have this payrolls report where the new jobs created exceeds the estimates by such a dramatic number. And that's the headline, and all the politicians speak about how strong jobs are, and the market reacts to that. In the very same press release, the Bureau of Labor Statistics revised downwards the last 2 months. And then you look at the other surveys, like the household survey, which is a government survey, or the ADP report, which is a private survey, and they both show significantly weaker jobs than the household survey. In fact, than the payrolls report. In fact, the household survey, which is another government report, shows that we lost 400,000 jobs in May. But the market just focused on the one. So I don't think the jobs picture in the US is anywhere near as strong as the one report, the payrolls report, would indicate. Remember, with the payrolls report, if people take a second job, that counts as another job. So if you have a person working 2 part-time jobs just to make ends meet, that counts as 2 jobs on the payrolls report. And that person, that's not a sign. The fact that people have to work 2 part-time jobs is not a sign of a healthy economy to me. So I don't think the jobs picture is anywhere near as strong as the payrolls report would suggest. So I think this is temporary. I think there's always follow through to these things, right? We'll see. But I think it'll only be a week or two, and I'm not expecting gold. I'd be surprised if gold drops and stays under 2,300. But I doubt very much if it's going to go under 2250.
Well, Adrian, it's interesting with the metals rolling over that a lot of this actually started in mid-May, long before people knew about China not buying in May from the central bank and long before they had that jobs report. So it looks like when you look at the charts, and not just gold, but silver and copper and other metals like zinc and aluminum all kind of rolled over mid-month. And so what my question is before this, leading up to this from February to mid-May, the narrative was that investors were getting interested in commodities again, because we saw a lot of commodities springing to life. We saw a lot of metals popping higher. We saw a lot of breakouts to new all-time highs, not just in the metals, but even in some of the related mining stocks. Copper stocks broke out to new highs. Some of the gold and silver stocks got moving, but it was kind of an exciting time. And now it's 2 weeks later, everybody's crying in their beer about, hey, things are pulling back down again. Do you think some of it was just that the sector got a little overheated? And in addition to that, on the comics, there was margin increases in copper 4 different times. There was 2 different margin increases in silver, a couple in gold. That usually crimped the speculative fervor. Do you think that it was just a little overheated and this is just a healthy consolidation?
Well, I'm certainly not crying in my beer. I don't drink beer, but I'm not crying in my wine glass. Yeah, I think you're absolutely right. I mean, when you see gold go from 2,000 an ounce at the end of February to 25,000 in mid-May, I mean, that is just an astonishing, and frankly, an astonishing move in what is a defensive insurance asset. And one shouldn't expect that to continue. And of course, when you say that gold already started to move down before it was announced that China had stopped buying, well, perhaps it was actually the mere fact that China wasn't buying that helped to bring the market down. If the major buyer was not in the market, even if no one knew it wasn't in the market, that should have an impact on the supply and demand. So, yeah, I think the market's just got a little bit ahead of themselves. I disagree on the stocks. I don't think the stocks by and large had really, despite the strong move, what was it, 30% or whatever in the GDX, I don't think the stocks had got ahead of themselves by any means. The valuations on some of these stocks remain just ridiculously cheap. And we've mentioned this before, but you just look at Agnico. Because it's selling at basically close to its lowest price to free cash flow in the last 40 years. Now, of course, the stock price went up in March, April, May, but so did the price of gold. So the price of gold for the second quarter is so far, depending on what happens for the rest of this month, but the average price of gold for the second quarter is still $350 an ounce more than the average price for the first quarter. So the valuations remain very cheap. And the free cash flow for these companies in the second quarter should be very strong. Again, given that gold is significantly higher on average for this quarter, and given that the oil price has come off a bit, oil being a major cost input, of course, for mining. So the free cash flow should be very strong this quarter. It should be stronger than the first quarter, which was already a good quarter.
You're right. And these majors have been doing well in terms of building a balance sheet. But even look at something like GDX here, Adrian, and GDX is trading at levels that it was at kind of in April of last year when gold was around, let's say, 2,100. And then you even go back to the other times that gold made runs up to over 2,000. GDX was actually higher. So there does seem to be this almost restrained capital that isn't just flowing into these gold stocks. Is it because other sectors are doing well, other markets are doing well, or has there been just a general narrative shift here where it's only a handful or select stocks that are going to continue to outperform this market, and we're not getting that kind of rising tide environment where all stocks are breaking out together?
Yeah, no, I think it's two things. The first thing is, people are a little bit cautious about the gold stocks because they've been burned several times before. A lot of people were burned severely in 2011-12, of course, when the XAU, I go by the XAU, but the major stocks were down 85% until you got to the bottom at the end of 2015. Maybe they gingerly stepped back in 2020 with COVID, and then wham, they got slaughtered again. So I think generalists, people who are not used to this sector, are certainly cautious of getting back in. But I honestly think the bigger factor is this. Look, why was gold going up? It was going up primarily because of central bank buying and because of Chinese savers and investors buying. And in both of those cases, they were not looking at the macroeconomic environment, and they certainly were not looking at the U.S. economic environment. So the central banks were buying, as we know, to defend and protect against the weaponization of the dollar and diversification away from the dollar. And the Chinese savers were buying because of concern about the banking system in China. They wanted a place to save. Stocks didn't look very good. They continued to go down. Real estate is not the place where a Chinese saver wants to put their money right now. Bitcoin, they're not allowed to buy crypto. So gold was the beneficiary. So there was, for central banks and for Chinese people, it was a sort of, gold was a natural destination. For a regular, what we'll call for a regular investor, particularly a Western investor, they're looking at relatively high interest rates. They're looking at a strong dollar. They're looking at a strong or reasonably strong economy. And they're looking at a strong stock market. Why would you want to buy gold stocks in that kind of environment? Now, I would like to buy gold stocks in that environment because that's precisely the environment, the dark before the dawn. It's the environment where the stocks are ridiculously cheap. But it's not an environment in which gold stocks typically do well. In fact, it's a bad environment for gold stocks. So most investors are just simply not looking at gold stocks right now. And that in all the reports, that in fund flows, if you look at the GDX, their fund flows have been, for the last 3 months, have been negative rather than positive. And you look at mutual fund flows, they're not positive at the moment. People are just not interested in gold stocks at the moment. That will change. I think when those factors start to reverse, when 1, 2, or 3 of them reverse, when it's clear that the U.S. economy is slowing and moving into a recession or unemployment moving up, that will see some interest in gold because it suggests that the Fed will ease. When the Fed actually does ease, that will certainly get interest into gold. When the dollar drops, that will certainly get interest into gold. But at the moment, and when the stock market rolls over, but at the moment, the environment is just not a positive environment for gold stocks.
Well, Adrian, when you look at the GDX, like you say, it's only about a 30% move that it had. But when you look at, and so that's kind of the passive investing side, which a lot of investors, if they are in the precious metals, they do access it through the ETFs. But when you look across the spectrum of mid-tiers, maybe not so much the majors, but the mid-tier in both gold and silver, a lot of those stocks were up 100 or 200%, not just 30%. And some of those weren't even included in the ETFs. And there were also some developers that had really big moves in the gold and silver stocks, up 1 to 2x, from where they were at the bottom in February. Is it possible that the passive investors didn't get as good of returns as maybe the stock pickers, people using a rifle approach versus a shotgun approach? Because there was a lot of action in the mining stock, but maybe not so much the ones that are just stuck in the ETFs. What do you think about that divergence?
Sure. No, I mean, obviously, whether the active investor got better returns depends on what stocks he picked, of course. But yeah, no, your point goes exactly to what I'm saying, which is that the generalist was really not involved in the market. Because the generalist initially might buy Newmont and Barrick and perhaps and Franco and Wheaton, maybe Agnico. But they don't go down much further than that at the beginning of the bull market. They stick with the ETFs. And there were outflows from the ETFs. It was very much a case of, in my view, it was a case, you had two buyers. You had the gold buyer who was already in the market, who was following it. And that's the person that was buying, as you say, the single asset developers and the companies that had really strong moves. That's where that buying was coming from. And then you had big players who were taking very large positions in stocks like Barrick or like Agnico. But the generalist was just, and that obviously moved the price of the GDX, but the fund flows were all negative, primarily negative for the GDX. So no, I mean, you're absolutely right. But I think it's a matter of who was buying. It's not that the person that a year ago would have bought the GDX decided to buy individual stocks instead. At least I don't think that's what happened. I think it's people who follow the market were buying individual stocks. And to some extent, to a large extent, anecdotally, talking with different brokers, both in Canada and the US, looking at funds, mutual funds, anecdotally, I would say that there wasn't an awful lot of new money that came in. So for every stock that doubled, there were a lot of stocks that stayed where they are or went down 10 or 20%. I don't think there was a flood of new money, but certainly not into the passive vehicles. There wasn't.
Yeah, that's all that we were hearing too, is that there was a whole lot of us still trading amongst each other, but at least there were some gains, right? A lot of these stocks sold off so much that they have rebounded. Hopefully that is a bit more of a trend change for these stocks where they can continue to tack on some newer, higher levels rather than that continued drift that we saw. Adrian, broadly though, because I know you're invested in majors, royalty companies, and even a few explorers, including prospect generators, where are you seeing some of the best opportunities for investors right now?
Well, very idiosyncratic right now, frankly, because as you say, we had the moves in gold, in the major gold stocks and the second-tier gold stocks, and the pullbacks by and large have been reasonably modest, given a run-up. So just to pull up Agnico, for example, Agnico went from $45 all the way to 70 and a half from the middle of February to the middle of May. Okay, so 45 to 70, and now it's a 65. So yeah, it's pulled back from the top, but it's still a very small part of what it gained. So I think the things we're looking at right now, frankly, it's idiosyncratic rather than any particular broad thing. I still prefer, at this stage in the market, I prefer to emphasize the major stocks because they will be the first ones that receive the flows when the flows do come in, right? Barrick is looking very cheap to me, for example, at $16. It's a company that's in the penalty box. They've missed earnings for several quarters. Optimistic earnings estimates, I would say. Optimistic guidance, I would say. They've missed the guidance that they themselves set, and they've had political issues, of course. So I think that one, with gold and copper, because Barrick produces a lot of copper, prices are higher. As I said, prices are higher in the second quarter. They should have a good second quarter. Franco, I think, is still a good buy. It's come down after the recent rally, so I think that's a good buy. B2, I think, is very cheap. That's obviously, it has been low. It had a good rally. Now it's come back again. They're building Goose Bay, and anytime a company is building a mine, people are a little bit nervous because you can only get bad news. If they do everything on time and on budget, and they actually borrow money from the bank, it's all what you expect them to do. So you can only, the surprises are all negative surprises when you're building a mine. And I think the fact that B2 decided to sell a portfolio of royalties that they own, not that was a bad move, it just makes the market nervous. Do they need money? Are they in need of money to finish building Goose Bay? But I think that's a good price right now. So it's all very idiosyncratic, frankly, and we could or we needn't. But among the juniors or explorers, I mean, there's some we're buying, but frankly, most of them we're just waiting to see if prices get a little bit lower. But some of them are just some of them, as you've mentioned, are just remarkably inexpensive right now.
Okay,
So
it really sounds like you're looking at some of these majors that haven't gone through the same appreciation that we've seen in a couple of the other majors. That really just speaks to this market, right? It's select stocks that are making runs higher. At least it's more stocks than we've seen during that last 4-year bear market that these stocks experience. But there isn't just that rising tide that is lifting everything to new, let's say, much higher levels. We have seen a rebound in pretty much every stock, but they sold off so much over those 4 years. Still a lot of upside to make up here. So, Adrian, you have given us a couple stocks, a few of the majors, again, that you're looking at to show that maybe more money will come into this sector. Maybe new money will come in, and that just can build on itself. It's a process, and we are only about almost 3.5 months into this rebound, especially for the stock. So let's see if that momentum keeps going through summer. Adrian, thank you very much for your time. Again, Adrian Day, president of Adrian Day Asset Management, which I will post a link to below. Adrian, have a great rest of your week. We'll chat again next month.
And thank you very much, both of you. Thank you.